Good work. There it is.
Well, I guess I'll just flip it then.
Yeah, you flip.
Okay, so I'm going to flip it, John.
Okay.
So good afternoon, everybody. Very nice to talk with you. I heard your comments, John, about I'm a partial Bruin, but I don't really acknowledge that, just for the record. So
I didn't think you would, but I had to throw that in there, you know?
yeah, no, I get it. No,
Okay.
John is like the key member of our investment committee at Paulus Productions, and so flattered that he'd asked me to speak with you guys. But I'm going to speak about a subject that I'd like to talk about, which is the company that I started in 2009 called Athene. And in the middle of the presentation, or at different points of it, I'll also maybe give you some comments, at least my views on active versus passive investing, if that's of interest. Everyone may have different views, but I can give you mine. So that picture at the beginning here is a picture of our operational headquarters in West Des Moines, Iowa, which we acquired the building as part of an acquisition we made back in 2013 of Aviva's U.S. operations. So page 2, John mentioned I'd worked with Eli Broad at SunAmerica. It was a fantastic place to work. I learned a ton from Eli. The kind of people to hire, you know, high character, high quality people, focused, know why they come to work every day. He also focused on the right demographics at the time, baby boomers planning for their retirement, trying to serve them, which was the fastest growing segment of the population. And this is where I worked for 20 years from 1986 till 2006. So on page 2, on the left-hand side, you know, SunAmerica was the best performing stock on the New York Stock Exchange during the decade of the 1990s. It appreciated actually from the low to high after AIG bought SunAmerica, 21,300%, so 213 times, which tough to replicate that, but really fun place to work when every day you come in, the stock price is going up, and if you have a fairly significant amount of your pay in stock, that is a great thing. And so learned a ton, grew up in the organization, got a lot of experience on both sides of the balance sheet. We started a new product that's now an industry standard called a funding agreement backed note, which is essentially a bond that's an insurance liability that has liquidity in the secondary market that most insurance companies now have some of that on their balance sheet. SunAmerica was the leader in it, and now Athene, it's the leading product for Athene as well. As you can see on the left side, we eventually sold SunAmerica, the stock price appreciation, et cetera, to AIG in 1999 for 6.6 times book, when most insurance stocks nowadays are trading at about 1 times book. So everything was just great timing for Eli. He was a fantastic mentor, and was really a great place to work. AIG bought us in 1999. I stayed on until 2006, and during that time from 99 to 2006, I became chief investment officer of their retirement savings group, which was a $250 billion asset entity. And all of my background set the stage for starting a new company that was founded on the business model of SunAmerica that we named Athene. My partner, Chip Gillis, brought to the table a domicile in Bermuda. He had been on the street and most recently working at Bear Stearns when Bear Stearns was an entity back then before it was bought. And so the business model that we talked about was pretty simple. So I'm on the next page now. It was make more on your assets than you pay on your liabilities. So while we own insurance companies, we really were not in the insurance business at SunAmerica or now. Instead, we're in the net investment spread generation business, kind of like a bank. You know, fund yourself at a lower cost than you can invest the money. It's a little more difficult to implement as you get bigger and bigger than that, but down to its basics, it's that. That's what Sun America did. That's what Athene does. But Athene also added some additional enhancements to the Sun America business model, including being domiciled in a very tax efficient regime in Bermuda, which has a 0 corporate tax rate. Sun America was in the variable annuity business. Athene's not going to be in that business. I was never a fan of that business. If you look at all the different riders and expenses, et cetera, associated with being in that business, and how many dollars fall to the bottom line, I think it's, I mean, you have to have like such scale to really have it make a difference. We're not going to do that. And the investor takes the investment risk. We want to be in a business where we're taking the investment risk and get rewarded for it. So with those enhancements, we set off on our way, although when I left Sun America to start this new enterprise, Sun America AIG, in 2006, my partner and I traveled around the country talking about the success of Sun America, the business model, association with Eli Broad, and the stock price performance. Got a fair amount of reception. But, you know, fundraising never really goes exactly the way you want it to. And that was the case with us as well. In 2007, so a little more than a year, a little about a year after I had left Sun America, I was going home after a lunch to sign the funding papers for this new entity, Athene, from a different private equity source than we ended up eventually going with. On my way down to sign those papers, I got a call from my doctor who said, your blood test you just took is a problem. You better go up and go to the cancer center. And which is really a shock to me because I've been a competitive swimmer, and every time I turn into a new 5-year age group, I get serious and try to set records. And in April, 1 month before this, in April of 2007, I just set the national record in the 200-yard butterfly for 50-year-olds in great shape. But after that, I developed a low-grade fever, had some night sweats, and was very unusual. And I went back in, and my swimming wasn't going the way I wanted it to. After the swim meet I just swum in, I was tired, et cetera. So I got checked, even though I had just had a physical a few months before that. And my doctor had said I was the healthiest patient he's had. But the blood test showed that I had acute lymphoblastic leukemia, which was a stunner. I think I actually had it when I broke the record a month earlier. But I had young kids who were 1 and 3, and it was really a shock, and there really wasn't a cure for it. So that put everything on hold, obviously, for the business, and eventually led me to having a bone marrow transplant, with my sister being a perfect match. I had that at City of Hope up in Duarte, and been lucky enough to have a doctor named Dr. Stephen Foreman, who I think is one of the best blood disorder doctors in the country. And he was my doctor, and the grace of God and family support and the transplant, I eventually got through it and got stronger over time. And eventually relaunched our efforts to start this new company. And the ironic thing is, if I hadn't gotten sick and we signed the funding papers from this bank that we had been talking to, we would have made it through the financial crisis that was coming, the great financial crisis of September of 2008 into 2009, but it would have been a lot more difficult. Instead, because I got sick, our start was delayed until after the financial crisis in 2009, when we aligned with Apollo and got funding from them. And at that time, in the immediate aftermath of the financial crisis, both assets and liabilities in the insurance sector were quite a bit cheaper than they had been. On page 4 now. And our association with Apollo had given us capital, permanent capital to deploy. So we bought some cheap liabilities. We deployed them into a fixed income portfolio against these liabilities. In the particularly cheap sector of the fixed income asset market then was structured securities like residential mortgage-backed securities, collateralized loan obligations, CLOs, some asset backs. And we had fortunate timing. And a lot of other insurance companies had gotten into trouble with owning these CLOs and RMBS. And so they had changed their investment policy to say, you guys can't own these anymore because they contributed losses. Unfortunately to them, they bought these securities, above par at just the wrong time. And then they put a prohibition on buying them at just the wrong time when they were trading at 70 or 75 cents on the dollar, which is when we bought them in the financial crisis or just after it. So you can see on page 4, the insurance industry was in trouble after the financial crisis. You can see the impairments on the left side spiked in 2008, and in 2009 were a bit higher than historically as well. They put on liabilities in size, and they didn't have the asset performance to support them. And capital, as a measured by price to book value multiple, took a plummet as well in 08 and 09. So it's a good time for a company like Athene with a clean balance sheet and a lot of capital to come in and swoop up some cheap assets and liabilities. And I would never have predicted things would have gone as well as they have back then, but we've become the most successful startup in the history of the life insurance industry. So page 5, talking about Athene, we've evolved through 3 primary phases of growth. The early stage growth, we really started by making acquisitions. We bought a company named Liberty, then Investors Insurance, and then Presidential Life for $15 billion, the sum of those 3. The transformative one was the picture on the building that we bought associated with the Aviva acquisition. That was a $15 billion company, Athene, buying a $60 billion company, Aviva. We kept 45 of the 60, reinsured off the other 15. So we now were 60, and it gave us the infrastructure to be in the retail annuity business and other businesses that we weren't as a startup. And then a real game changer for us as well was at the end of 16, we went public on the New York Stock Exchange in an IPO. It went really well. Our IPO price was $40, ended the first day of trading over 43, went straight up to 55, an $11 billion market cap. And then tax reform came into play. And one of our competitive edges is, a very low corporate income tax rate compared to others. And investors started worrying that we weren't going to grow like we had because our competitive edge on taxes wasn't there. But we did some very run-of-the-mill restructuring, et cetera. So we kept our tax advantage, kept growing to our current size, which is close to $200 billion of invested assets. And this year we're going to make probably close to $2.5 billion of after-tax income. Excuse me. So one of our monikers is driven to do more. It's for a lot of constituents, our policyholders, people who buy our policies. A fixed indexed annuity is our main product. Business partners, shareholders, and communities. I think we have the best management team in the country, with a variety of different experiences, some specifically to insurance companies, some working on the street for different investment banks. For instance, Bill Wheeler, the second guy there next to me, he was the number 2 guy I met. Got us into a couple of different businesses. Grant Cavalheim used to call on me when he worked at Merrill Lynch and Deutsche and Barclays, and he runs our Iowa operation. Marty Klein was the CFO of Genworth and done a very good job for us here, et cetera. I mean, it's a group that knows why they come to work and want to make a difference, and we're in a hurry to make that difference. So page 8, we've posted very good financial results. We've outperformed other insurers, which I think is a pretty low hurdle, but a hurdle nonetheless, on every financial metric. Our average return on equity over the last 5 years has been a 500 basis point outperformance. Our earnings per share growth been an 800 basis point outperformance, and our growth in book value per share has been 1,000 points, so 10 points higher than the industry average. You can see the growth in our invested assets on the next page from just over the last close to 5 years, from 67 billion to 182 billion. which is a compound annual growth rate. That's what CAGR stands for, of 40%. And on the right is our adjusted operating earnings per share, 30% annual growth rate. And we've more than doubled our earnings power over the last 5 years. And you can see that over $2 billion of after-tax operating income we're expecting this year. You know, I mentioned that we own insurance companies. That's really to provide low-cost, persistent, predictable funding that can fund our alpha-generating asset philosophy and investment performance. So we really don't have much mortality risk like a typical insurance company does. Like I said, we're probably more akin to a bank or an asset management company than we are to an insurance company. But since we own insurance companies, insurance analysts follow us, unfortunately. So you can see how we've done compared to others, not just insurance companies. So on the left, on earnings, for the last 5 years, the universal banks have grown earnings 4%. We've grown them 7%. But it has not been reflected in our stock price. You can see our price to earnings multiple compared to these universal banks theirs is 11.6 times and ours is only 6.9 times. On return on equity, for the last 5 years, trust banks, we've outperformed by 300 basis points, mid-teens to their 11. But again, our stock price hasn't kept up. It's only 6.9 times compared to their 11.3 times PE. And our book value growth, 7% for brokers per year. We've been at 12% over the last 5 years. And again, underperforming stock price, which is relevant because it was part of the reason that we merged with Apollo, which I'll get to. Just some more metrics to look at now on page 11. Organic growth, day-to-day premiums coming in from our retail business, from our wholesale business, from our reinsurance business. Traditional asset managers have grown 1% per year, and we've grown 26%. And you can see the same stock price story. The funding model, ours is definitely better for universal banks. 2/3 of all their deposits can be withdrawn at any time, meaning demand deposits, meaning you got to hold a bunch of liquidity in your asset portfolio to manage that withdrawal risk. We have very little, if any, on-demand liabilities because they're almost everything we sell by design and reinsure is protected by surrender charges. And customers hate paying surrender charges. It's a significant deterrent to surrender activity. And it's meant that we can invest with certainty, take some liquidity risk, and get higher returns because of that. And then we have a more scalable business than annuity issuers on the right side. Their expense ratio is 4 times what ours is. And we've slightly outperformed these annuity issuers in stock price, but not to the extent we should. Talked about that liability growth that funds our asset strategy. So on page 12, just reiterates what I just said. It's low cost, persistent liabilities, essentially funding our alpha generating asset model, investment model. Our average liability life is 9 years. So you do a lot of things on the asset side when essentially you don't have to pay the principal back for 9+ years. 3 big pictures trends that I wanted to just point out that we think we're very well positioned to take advantage of our company. An aging population provides opportunities for products we sell. We're providing retirement solutions for people planning for their retirement or already in their retirement. We sell fixed indexed annuities, general fixed annuities. We also provide pension solutions that I'll get to in a second. So this industry trend is illustrated by the fact that the US population of over 65-year-old people continues to increase as a percent of the population. From 2020, it's expected to be from 18% increase all the way up to 26% of the population by 2040, consistently adding people to our target audience. And you can see on the right side that some demographics of our typical policyholder. Where we have 600,000 policies in place. Our average age, 68-year-old buyer, and they put in about 100,000. Big picture trend number 2 You can see corporations are increasingly looking to shed legacy defined benefit pension liability. There's a crisis, a pension crisis in the US and overseas. The two markets we've attacked here are the US and the UK. The UK is actually ahead of us in trying to solve their pension problems and their retirement problems. But so instead of relying on the Pension Benefit Guarantee Corp, PBGC, we and some other insurers, but we've been quite successful in coming in and offering a better package of benefits to pensioners who are either still at the company but have a pension plan or have left the company. We can invest money at a higher yield. We can offer higher premium dollars to them and benefits to them. We have the actuaries that can underwrite the longevity risk. So you can see benefits of PRT solutions, reduces earnings drag, volatility and drag, reduce the PG. These are all to the benefit of the company. PBGC premiums are lower with us. It's a de-risking effort, and we've really established a niche here. I mean, it used to be just the purview of the Met and Pru, the big insurance companies, or AIG, but we're the number one issuer of PRT solutions in this market last year, and we're having a really good year this year as well. You can see the addressable pension risk transfer, that's what PRT stands for, market in the US is $3 trillion. In the UK, a much smaller company, it's 2.7 trillion, so almost as big. The average US PRT transaction volume per year is about 27 billion. So far over the last few years when we've been in the business, we've done 16.3 billion in this market. And the UK is 44 billion per year, and we've done our one deal for just under $1 billion. So very optimistic this is going to continue to be a growth area for us. And the final big picture trend I wanted to comment on is the life insurance industry is restructuring. And most of the times restructuring, there are things on insurance companies' balance sheets that they don't want. It's not their primary business focus. It's not what they're concentrated on. And they like to unload it. And they'd like to free up capital. The most important thing that we offer as a solutions provider to the insurance industry is capital. We have it, and a lot of other companies need it. And we have it because Athene and Apollo have been very successful in raising capital from third-party investors who first and foremost have been very happy with previous opportunities Apollo's provided to them, and so they want to re-up. So I don't know of another company that has as much dry powder in the form of capital as we do, which allows us to be opportunistic to provide solutions to the insurance industry. And that often comes in the form of an inorganic deal, an M&A deal, or a block reinsurance transaction. And you can see the ones we've done since 2008. I guess these are all the inorganic deals we've done. It averages out to be about one of these deals per every year and a half. Again, the Aviva one that ended up with 45 billion for us was really the game changer. So between us and Apollo, there's something on most every insurance company's balance sheet that they want to get rid of that we have an interest in. So for instance, in 2018 or in 2017, Voya, another insurance company, had a variable annuity business that they weren't happy with, and they wanted to free up capital so they could buy back stock that was trading very cheaply. So Apollo stood up a new variable annuity entity called Venerable and essentially took over their business, recapitalized it, reduced the tail risk, and it's been very, very successful. And they weren't going to do that unless its partner Athene got what it wanted. So we also got 19 billion of fixed indexed annuities that fit right in with what we do well, and we can generate net investment spread on. So that's, I mean, the combination of Athene and Apollo is pretty unique and powerful in producing solutions for the insurance industry. And then most recently, right during the pandemic, shows we did a deal with Jackson National for $29 billion, fixed indexed annuity, reinsurance, freed up capital for them, and right in our wheelhouse of what we wanted to put on our books. A couple minutes on investment strategy, and I want to make sure to leave time for questions. Since our liabilities are all fixed income like, our assets are that as well. 95% of our asset portfolio is fixed income assets, almost all investment grade, rated by the rating agencies. The other 5%, we try to get some more yield by investing in some alternatives like private equity and hedge funds, but not traditional private equity and hedge funds. I'll get to that in a second. So we've typically outperformed others in the industry on our fixed income returns because we don't just buy liquid CUSIPs on the run assets that have been really bid up in price and driven down in yield. That's not the way our business model works that well. Instead, we try to directly originate fixed income assets, eliminate any middleman of a sourcer, and take some liquidity risk, some structuring risk, not more credit risk. And we do that as long as the yields justify us taking those kind of risks. And we can do that because of the nature of our liabilities. There's no on-demand money coming and asking for their money back. Downside protection is another key tenet of everything we do before we buy an asset. We see how it would perform in a repeat of the great financial crisis, Lehman, et cetera. And that gives us a lot of comfort that these assets are going to perform well through thick and thin. And again, they're matched against our liabilities in duration and weighted average life, so you're never short money. Our structure is a little different than others. My Son America experience was that the asset people were in the insurance company just like everybody else. Here with Apollo, when we started Athene, Apollo already had a large asset management organization. It's gotten a lot bigger because we've been part of them, but there's no need for us to replicate what Apollo already have. So until we announced the merger, we've been two separate companies. I was from the beginning of Athene, the only joint employee, both Athene and Apollo, which meant I could make sure the assets and the liability people were talking to each other. But Apollo is not just an asset manager for Athene. It's the most unique and powerful relationship I've seen in my career. They do a great job of managing our assets, but they also help us with M&A sourcing, capital market support, risk management in the form of asset liability management, transaction diligence and structuring. They help us with the rating agencies and regulators and general operational support. We're Apollo's biggest client. Apollo is Athene's largest shareholder. And the relationship has been fantastic. We wouldn't be where we are today without them and vice versa. And we kind of see the world the same way. Just some details on our current investment portfolio. I mentioned the fixed income nature of our liabilities. This is fixed income. Our $182 billion, about half on the right side of the pie, are in corporates and government, mainly corporate bonds. You're not going to make a killing on those, but it's a good source of some yield, liquidity, and security. With the other half of the portfolio, we invest more than others do in structures. So you can see, well, and some real estate. Commercial mortgage loans are 12% of the portfolio. CLOs are 10. RMBS and RMLs, that's residential mortgage-backed securities and residential mortgage loans, 9%. Asset-backs, 9%. And you can see the alternatives are 5%. In our alternatives, we don't buy just traditional hedge funds and private equity. Instead, we invest in funds that don't take binary bets, cash flowing features, downside protection, underperform in roaring equity markets, but will far outperform in flat to down equity markets. And that's what we've seen. These directly originated high-grade alpha assets, we do that if we can get an extra 100 to 200 basis points of yield versus very expensive public securities. And look, our defaults have been lower than others in the industry because we haven't taken extra credit risk and have really engaged in disciplined downside protection underwriting. I think we've talked about this in general. I mean, right through the pandemic in 2020 was our best year ever. Between our inorganic deal with Jackson and our organic, we brought in new $56 billion of spread-based liabilities at very attractive returns, almost evenly split between organic and inorganic. And we invested all that money at a 40 basis point premium to the BBB corporate index, net of fees. And for the first time ever on the right side under scale, we were number one at each one of our channels, which is retail annuities in the States, flow reinsurance, essentially around the world, pension risk transfer, and funding agreement-backed notes. We were number one in all of those, as well as inorganic because of the Jackson deal. We're now in the US, Bermuda, Canada, the UK, Japan. We have a reinsurance business there. And are now actually this year now in Australia. We have some exposure to a Australian company that we think will continue to grow. In the UK, we're in the pension risk transfer market. On 20, talked about our outperforming others. Since inception, we've grown book value per share at a 17% compound annual growth rate, more than 3 times peers who are at 5% growth. And since we announced the merger with Apollo in March 8th, it's really been a huge impetus to growth in the stock price. The market's starting to get our operating performance and appreciate it. And now we're completely aligned with Apollo, so there's no conflict of interest. I think the market likes that. We still have a lot of work to go educating investors. But so far this year, the stock is up 60%. And our market cap is now $13 billion on a standalone basis. One of the things we think we're going to get from the merger that'll happen at the beginning of the year with Apollo is a financial juggernaut company, all under the Apollo name. Athene will continue to be its largest part. We'll continue to run Athene as we always have. But we think this entity will be a prime candidate to be in the S&P 500, which will add liquidity and it'll just be a great thing for a number of reasons. I mentioned on 21, as I get close to finishing here, we're well positioned for continued growth. I've said that capital has always been one of maybe our number one strength. And if you just look at the growth trajectory since 2017, we had 72 billion of invested assets. And then we've fast forward through organic and inorganic. First quarter of this year, we had 182 billion. Over the next 4 years, we'll add over $100 billion of organic inflows. We'll add over $100 billion of inorganic, and then some outflows, but we think we'll be at least 320 billion in invested assets over the next 3 to 5 years, because we have $8 billion of deployable capital that produces buying power of over $100 billion. Before I finish, just a couple more things. We're in the right demographic. You can see the tailwinds. Total U.S. retirement assets between 2000 and 2020 are supposed to go from 12 trillion to 33 trillion, almost 3 times increase. The need for income continues to go up, given the fact that the 10-year treasury, as we speak today, is at 130. People want some income, and we can provide that with our products. Wealth transfer, about 35% of total U.S. invested assets expect to be transferred between generations over the next 2 decades. And just to touch on the final point regarding investment philosophy, you can say we have Apollo as our investment manager. Look, in general, passive money is just outweighing active money. But in fixed income, given our different philosophy and direct originations, et cetera, taking some liquidity risk, we have a track record of being able to outperform any passive index and indexification in general. It's going to continue. You can see the passive share of mutual and exchange traded funds on the right side of 22. It's gone from 4% in 2000, 10 times increased to 40% in 2020. But we're not going to succumb to that. We think there is value in active management in certain sectors, and where we are in fixed income, that's one of the sectors. John knows that at least my philosophy in the large cap equity space, very tough to outperform the big indices like the S&P 500 when you subtract fees for active management, et cetera. So I'm a big proponent in that very efficient space to go with a passive approach and just buy the index. But we're not doing that in this fixed income space where we operate. And then just the final point on putting some numbers around our business model. It's pretty simple. Is to say an illustration is we make about 4.25% on our asset portfolio of fixed income and 5% of alts. We pay the customer about 2.75%. We have operating expenses of about 40 basis points. So that's like 110 basis points of spread. You lever that 12 times, that gives you like 13 points. You add in interest earnings on your surplus and you get to 17 to 18% returns, which it says 15 to 20% IRR. And then finally the merger with Apollo, Apollo's gradually increased their ownership percentage of Athene. 18 months ago, they doubled their stake from 18 to 35%. And it was only a matter of time before we decided the complete combination made the most sense. I was pushing for it more than anyone because we needed to unlock value from our operating performance that hadn't been. I think investors in general who wanted to be in the space we're in wasn't going to buy both Athene and Apollo. They were going to choose one. And the fact that Athene pays Apollo over $1 billion a year in asset management fees, I think meant that they were going to choose Apollo. And so instead of bucking that trend, let's just combine to have only one public company, and that's what people should buy. And so far, so good. Still have a ways to go, but there's going to be a ton of benefits from the merger, faster speed to market, bigger company, candidate for the S&P. So very excited about it and continuing the growth of Athene and Apollo. And so with that, look, I appreciate your attention. Really proud of what we've done here. Really happy that John asked me to talk to you guys. Happy to answer any questions.
Well, thank you very much for that wonderful presentation, Jim. John, do you have a question?
I do have a question. Jim, with your great results through the years at Athene, return on equity, return on book, why wasn't it reflected more in your PE?
Yeah, I think that my last comment, I tried to address that. I think an investor who wants to be in this space, the retirement savings initiatives and asset management reliance, et cetera, wasn't going to buy both Apollo and Athene, especially when Apollo was owning 35% of Athene. They were going to choose one or the other. Yeah. So now that we're combining, I think it's more of only one alternative for this combination as opposed to diluting it between the two and only choosing one. And I also tell you, I think there's some hesitation from investors. They thought that, certainly when we started, less so as we went along and posted results, they thought that Apollo was going to be too aggressive in managing our assets and would walk away like a private equity company and leave other investors holding the bag. That was never going to be the case. I mean, that's why we're here, to make sure that's not happening and do our proper risk management. And now the results speak for themselves. And now that we're completely aligned, everything that goes on Athene's balance sheet, Apollo owns 100% of as well. So that concern has completely gone away.
Thank you.
Are there any other questions?
I have more.
Well, I don't see any other hands up, John. So take it away.
You spoke about the corporate pension plans, and they want to, get out of their pension plan liabilities. How about public pension plans like states and cities and the like? Yeah,
I think I'm not the one calling on the different plans. We have others that do that, but I think anybody with a pension obligation that it's certainly if they're underwater, they'd like to come up with a solution. So I think there's huge upside in all public, private, et cetera, providing additional solutions. Absolutely.
I get you. Yeah. Here's a personal question. Did you stay close with Eli Broad after you left Sun?
Yeah, thank you. So fortunately for me, over the last, I left Sun America AIG in 2006, so it's been 15 years. But I would regularly, every few months, call Eli up and just tell him thank you for everything he taught me and how much I appreciated it. And he was kind of like a mentor to me. And I had done that actually a few months before he passed away. So at least I felt good that I had contacted him relatively recently. He was always in good shape. He had a great work ethic. I remember traveling home on planes with him, midnight, et cetera. And he's still pouring through papers, et cetera. And it makes an impact on you. The guy had a lot of money. Yeah. That didn't deter his work ethic and his willingness to work and achieve. And that's important, and I think a good thing. So never really had any scandals either, like a lot of high profile people do. So he had a high moral character, and yeah. I just thought he was great and really smart. And so, yeah, it was great. I was lucky for me to be associated with him.
Was he easy to work for?
No, not at all. So by design, I mean, he was difficult. Look, he enjoyed the verbal back and forth. I kind of like that too. So that stuff never bothered me. You really went up into his book if you could ever, convince him that he was wrong about something. But I think that verbal back and forth and debate is really healthy. And we try to hire those kind of people on the theme. We want people that speak their mind, that aren't wallflowers, people that want to make a difference. And I got that from him, and it still works today. So, but I always liked him because I think he liked me. He respected what I said. And, but no, I mean, he always wanted to do better, which I get.
Yeah, I get you. That's good. That's good. Yeah. Tom Barron, don't you have a question?
I do. Jim, I presume most of your clients are corporations and private entities and things like that. What's significant?
Well, hold on a second. So it depends on which channel. So our retail business, our retail annuity business, we got 700,000 policyholders, sold through independent marketing organizations, banks, broker dealers, et cetera. You can go into XYZ place and get an Athene fixed indexed annuity. But you're right about in our pension risk transfer, their corporations, our clients, and our funding agreements, institutions buy those. And our flow reinsurance are other companies, but the retail segment is mom and pop.
Apart from your company, what significance are the unfunded pension liabilities of state governments to the general public and taxpayers general?
Yeah, I don't know, Tom. I don't have the stats there in front of me on that one, but I mean, I think anybody with pensions has just been, and it's the issue is going to come home to roost here pretty soon. More and more companies are realizing they got to do something. They're waiting for this market to do better, that market to do better. So the pain from coming up with a solution is less. But, at some point you can't wait any longer. And so, and we're proactively talking to these companies, hey, this is a good time to get out. Here's what we can do for you, et cetera. I think more and more are realizing that you just can't keep kicking the can down the road forever, whether it's public, private, corporations, et cetera. Most all of them who've had a defined benefit plan have problems.
I think that's right. Yeah. Yeah. I had another question, but I forgot it now. Just a minute. Oh yeah, passive and active management in the fixed income sector, Jim. I know you say you're able to use active management effectively. How do you get that? I mean, governments and high-grade corporates are pretty much efficient markets, aren't they?
Absolutely, but within our corporates, it's not all public corporates; it's some private corporates.
Okay,
private, you get paid for illiquidity.
I see.
But the private part of it, that 50%, but the other 50% is really what I'm talking about. That we're taking some structure risk in our structured securities like CLOs, asset backs, and RMBS. Structure risk, illiquidity risk, but we have to be paid for it. And so that's how we outperform versus the really efficient markets and direct origination. You're not paying the bank something to bring to us. Apollo with this worldwide reach, he's talking to companies all over the world, Middle East, et cetera, Silicon Valley, about some of their issues. And we do a lot of structuring of traditional deals into investment grade tranches, non-investment grade tranches, equity. So we add value through structuring significantly as well.
I see. That's good. That's good. Are you going to stay around now in the company?
Yeah, I like to work. Look, it is a little sad for me. I mean, I was pushing this merger with Apollo more than anyone because we needed to get the stock price up, and I think it's going to do great, and it's done already well since the merger announcement. But I like to work. I feel better about myself when I'm working and adding value. And so, yeah, I'm excited about helping Apollo and Athene going to new heights with Apollo. We've already been upgraded since the announcement, our ratings since the announcement with Apollo. So our cost of funding has gone down now for the last few months, and counterparties want to do even more business with us because we're a higher credit rated company. And I think that's only scratching the surface. So yeah, I'm as enthused and energetic as I ever was, but it is a little sad not being our own public company after we worked so hard on it for so long. But that's the natural evolution of our relationship. So that's what I expect.
So again, thank you, Jim. We appreciated the presentation today. And in your honor, we'll make a donation to the Westwood Village Library.
That's fantastic, Diane. It's great to hear. That was really a pleasure of mine.
Well, thank you. Our pleasure as well to have you here today. So next week, Dr. Chuck McCreary will be speaking on mindfulness and meditation. Same time, same place. Until then, everyone have a wonderful weekend, and thank you for joining.
Thank you.
Bye.
Bye-bye. Thank you, Jim.
Sure.
Thank you.